An economic crisis is coming to hit the global economy. There is a lot of uncertainty right now, and things are shifting extremely quickly. Numerous economic signs have been alerting us that a recession is about to start since the year 2023 got underway. In this video, I'm going to describe how the globe is set to experience a new recession and how it will be indicated by the key indications. Make sure to watch all the way through this video because I'll also explain how you can profit from this circumstance. The massive Bank of America said in April that the U.S. Federal Reserve's efforts to reduce inflation have hurt our economy too much. As you may know, the Federal Reserve got desperate and raised central bank interest rates to make all debt more expensive. As you will see, the interest rate hike was huge and not seen for decades. They did this in order to slow the economy and, as a result, cut inflation. And indeed, the latest figures indicate that inflation has plummeted to 5% in March 2023, the lowest figure in almost 2 years. But as usual, this figure is manipulated. It turns out that the definition of how inflation is computed has been altered by the U.S. Bureau of Labor Statistics. In the past, they had taken data from the most recent year rather than the most recent 12. But why did they change it like this? Well, because it was convenient for them to present a figure for inflation that was lower than it actually was, in order to purportedly demonstrate that the Federal Reserve has already fulfilled its mandate and that future increases in central bank interest rates are not necessary. The Fed has not, however, officially acknowledged this. They typically increase central bank rates to slightly exceed inflation when there is strong inflation. As a result, it is anticipated that these interest rates will keep rising through the summer. But as Bank of America points out, the harm has already been done, and we must now deal with the fallout. The crucial query, though, is how severe this recession will be. And this is where we have a significant problem. If you have been following the financial markets, they have recovered relatively well, and investors are optimistic that the Federal Reserve is going to start lowering central bank rates. This would consequently stimulate the economy and companies would generate more profits. Bank of America cautions, however, that investors have been excessively euphoric and are not being realistic about the impending crisis. And that gets us to the renowned government bond curve, often known as the yield curve, which is the first indication that a severe recession is likely to begin. The yield curve is one of the most reliable indicators of whether we are entering a recession. The yield curve or bond yield curve in the United States measures the difference between the yield on 10-year versus 2-year government bonds. In other words, if U.S. bonds have very high 2-year yields and are outperforming 10-year yields, that means a recession is coming. This is something that has been demonstrated every time in economics over the last 100 years, as you'll see here. And you may wonder why this indicates a recession to us. Bond yields are influenced by market demand from investors. Investors sell bonds with a 2-year maturity and purchase longer-term bonds, like 10-year bonds, if they perceive short-term concerns in the economy. Here you will clearly see how the yields differ markedly. 2-year bonds yield between 4% to 5%, while 10-year bonds yield between 3% to 3.5%, a difference of 1%. The inverted curve is so named because recessions frequently accompany this disparity. In other words, the yields on short-term bonds shouldn't be greater than those on long-term bonds. And today we are clearly seeing the inversion of the curve, and it is a powerful signal of an impending recession. This recession is the result of the Federal Reserve's desperate behavior in raising central bank interest rates 9 times in the last 12 months, taking us from 0% to 5%, which is the fastest tightening cycle in modern history. In plain English, this means that individuals and businesses with debt will now have to pay high interest rates on those obligations, which will slow down the economy and cause a recession. By examining the credit cycle, another indicator of a coming recession in 2023, we can validate this. The credit cycle is the expansion and contraction of access to credit and is a leading indicator of economic activity. The credit cycle peaks when credit is readily available due to economic activities. But the credit cycle bottoms out when there is a shortage of credit demand due to low economic activity. And as I explained, when central bank interest rates rise, the Federal Reserve slows down the economy as people and businesses borrow less money. Well, according to Bank of America, we are currently in the late stage of the credit cycle, which means that banking and lending activity is slowing and we are seeing a decline in credit standards. If you are enjoying this video and want to be aware of new videos, subscribe to this channel and turn on notifications. This is a red flag because when credit standards drop, riskier loans are made, which indicates that banks are rushing to extend credit in an effort to earn high interest rates. Giving out loans with such high default and financial instability risks puts the banking system at risk. This is something we are already seeing in the economy. In this chart you will see the credit card delinquency rates, for example credit card defaults. As you will see, we were at the lowest levels historically, but now they are rising rapidly. This serves as yet another notification that a recession is actually upon us. Now let's examine the third indication of a recession, which is the increase in demand for natural resources. Oil is the most significant natural resource here. Oil demand is a reliable sign of a recession, and the price of oil is currently falling as a result. In the past, oil prices have risen during expansionary times and fallen during depressed times. The recent oil price rise was during the conflict in Ukraine, as you may know. Now we are seeing the subsequent drop in price these past few months, which indicates a warning sign. The world is buying less oil. As you will see in this chart, every time there is a drop in the price of oil, there usually comes a recession. However, compared to the yield curve, this indicator is less trustworthy. Since oil producers are the ones who know their market the best, we must dig deeper to understand what they are saying. And OPEC Plus is the most significant producer organization in this area. OPEC is the organization of the petroleum exporting countries. Here are countries such as Saudi Arabia, Russia, Venezuela, and other countries. Being the biggest exporters of black gold, this group is a true cartel, and as such, they are the best placed to predict when there will be a drop in oil demand. In other words, when they see a time when the global economy is expanding and a lot of oil is used, they typically raise their output while maintaining the highest possible pricing. In a downturn, they do the exact opposite and reduce their output while raising the price of oil. It turns out that OPEC has been deciding to cut back on oil production for several months. In order to prevent a drop in oil prices, they are being extremely cautious about the overproduction of black gold as they were already anticipating a recession. The latest sign of a recession can be seen in the industrial sector, which is slowing down worldwide. According to the Bank of America report, the global index of industrial activity, known as the PMI, has been falling over the past year, which normally indicates a contraction in factory activity and other manufacturing industries. In other words, this index measures how much industrial company managers expect to grow, and how much activity they see in the industrial sector. When this index declines, the subsequent months usually bring a slowdown or recession. But in this case, the slowdown is happening across the board, affecting both developed and emerging economies. In the US, the manufacturing PMI has fallen to its lowest level in the last 10 years, as you will see in this chart, as industries are seeing a drop in new orders and sales. This is a blatant indication that demand is falling and businesses are reducing production, which alerts us to the imminence of a recession. The US dollar is starting to lose its position as the world's reserve currency, according to Bank of America. For many years, the dollar has been the dominant currency in the global economy, but this is starting to change. For international trade and investment, more nations are starting to utilize their own currencies or foreign currencies, like the euro or the Chinese yuan. The US economy may be affected significantly by this shift away from the dollar, which might result in increased interest rates, inflation, and a declining value of the dollar. A worldwide and American economic recession are both clearly on the horizon. We have examined every piece of data that supports this claim, and it is clear that the Federal Reserve's decisions had a significant role in its development. I'll now go into detail about how you can profit from all of this, though. You should prepare your money for possibilities first, I suppose. The stock market has presented us with some really intriguing possibilities over the past several months, but I believe there will be more because a recession is bad for the market. In this chart you will see in purple that the stock market drops on average 20 to 30% every time we go into a recession. But this is where the good news comes in. Only 1 year after a recession, the stock market rises by 30 to 40%, as you will see in dark blue, and after 2 years the stock market rises by 60 to 70% on average, as you will see in green. However, because we are unable to accurately forecast the optimal time to invest, I advise starting small and diversifying your portfolio as much as you can. We can say with certainty that a recession is coming this year after carefully examining all of the available facts. The most crucial thing is to be as prepared as you can be and to be open to new opportunities. We would like to know what you think about all this data, and give us your opinion about the coming recession. Leave it in the comments.